JeremyJSiegel, Stocks for the Long Run, the definitive guide to financial market returns and long-term investment strategies. Embark on a journey through the historical milestones of the U.S. economy and discover the power of stocks in the long run. With this summary of Jeremy J. Siegel's book of Stocks for the Long Run, the definitive guide to financial market returns and long-term investment strategies. Gain insights into the major transitions of the U.S. economy, from agrarian to industrial society, and its evolution into a global powerhouse. Learn how stocks have consistently outperformed other asset classes like bonds, commodities, and gold, providing a 6.6% annual real return for over 200 years. Understand the intricacies of portfolio construction, the impact of taxes on your investments, the role of behavioral finance in decision-making, and the changing world of investment instruments.
Two centuries of financial fluctuations. The U.S. economy has undergone significant changes in the past 200 years, but stocks have remained the most dependable asset class, with a 6.6% annual real return. Over this period, bonds and gold barely kept up with inflation, while stocks doubled their purchasing power every 10 years. While stocks have experienced tremendous volatility in the short run, they are still the best-performing asset class in the long term. Despite prolonged inflation in the 1970s and the 2008 financial crisis, equities promised their owners nothing but remain the most trustworthy investments. The root causes of the 2008 financial crisis. The 2008 financial crisis was caused by subprime mortgages and real estate investments, which had surpassed $2.8 trillion by the summer of that year. The high ratings given to mortgage-backed securities by major rating agencies gave buyers a false sense of confidence. However, the home prices fell by about 4% from June 2006 to June 2007. This decline destroyed the rating agencies' risk models for mortgage-backed securities. If a mortgage borrower defaulted, the underlying property was worth less than the mortgage. Regulatory failures and political pressures also contributed to the crisis. As a result of the downturn, real GDP growth fell by a record 4.3% from the end of 2007 to mid-2009, which propelled the U.S. economy into its second-longest recession. Constructing a robust portfolio. A portfolio is a combination of various securities that generate returns dependent on the investor's risk tolerance. To create a diverse portfolio, investors must understand their total real returns by examining dividends, interest, and capital value fluctuation. By studying historical data, investors can compare total real returns from different combinations of assets ranging from single to 30-year periods. The book suggests that countries promoting free market economics have contributed to the superior performance of stocks over the last 2 centuries. The standard deviation of average real annual returns outlines the portfolio's risk over longer periods. Stocks have the lowest risk, and a diverse stock portfolio yields consistent returns between 6 to 75%. Modern portfolio theory emphasizes the efficient frontier, identifying the minimum risk expected from a combination of stocks and bonds. Thus, variations in managed portfolios yield different risk and return profiles, helping investors gauge standard deviation of their average annual return. Invest in stocks for higher after-tax real returns. Long-term investors seeking to boost their total real returns after tax should consider investing in stocks instead of bonds. Since 1913, the after-tax real return on equities has ranged from about 2.7% to 6%, while bonds have ranged from -0.3% to 2.2%. Municipal bonds have an average annual real return of 1.3%, while treasuries ranged from -2.3% to 0.4%. Despite the recent financial crisis, the longest period it has ever taken an investor to recover from a bear market was 5 years and 8 months. Investor returns from stocks are primarily dividends, accounting for most of the 6.48% real equity return from 1971 to 2012. The future value of dividends determines stock prices, but earnings reflect various expenses over varying periods, which the FASB allows firms to report differently. Beating the market, factors to consider. A proper investment strategy is a psychological challenge, not just intellectual. Valuation data based on business growth, sales, earnings, and dividends are the most important indicators to consider when investing in stocks. However, relying on growth in revenue and earnings will often lead to below-average returns. The critical consideration in portfolio decisions is risk, which is the correlation of an asset's return with the overall market. This relationship is embodied in the capital asset pricing model, CAPM, where beta is the cornerstone. In the CAPM, an asset's beta is always present, and diversification cannot reduce it. Therefore, the share's beta is a risk for investors, and the company must compensate them for it. A diversified portfolio can mitigate risk independent of the market, requiring investments in bonds and various U.S. equities. Firms' market capitalization and dividend valuations predict an equity's return better than its beta. Analysts in the internet sector had a high propensity to shut out bad news. Investing in mutual funds? Check this out. Long-term investors should calculate the average annual performance of all publicly traded funds to find the ones that beat a particular index. Many funds benefit from survivorship bias, and investors need to identify how trading and management costs impact their returns. Paying a 1% annual fee over 30 years can reduce a compounded return of 11% by 1/3, while a 3% fee would eat up more than half of the return. Understanding ETFs and stock index futures. Exchange-traded funds, ETFs, are investment company shares that continuously trade and represent an underlying portfolio, including traditional and customized indexes and actively managed funds. ETF assets hit $1.3 trillion, growing 13 times in size over a decade till 2012. The first ETF, S&P 500 Depository Receipts, SPDRs, nicknamed Spiders, posted the highest dollar volume of any security traded on a U.S. stock exchange. Compared to mutual funds, ETFs offer flexibility as investors can trade them anytime and sell them short, and are more tax efficient. On the other hand, stock index futures, which began in the early 1980s, opened doors to program trading that links price movements between index futures and New York Stock Exchange's cash equity market. Stock option index trading, starting in 1978, provides more strategic possibilities than trading stock index futures and calls and puts bets on the market's upward or downward direction. Informed investing. Learn how understanding behavioral finance can improve your investment decisions. Investing is no longer viewed as a purely rational decision-making process. Behavioral finance has revealed the significant impact of emotional factors on investment choices. Financial experts now recognize that the way in which individuals think and feel about investing affects their decision-making process. Behavioral finance identified several significant psychological factors that drive people to make good or bad investment decisions. These include loss aversion, where people avoid losses more than they enjoy gains, prospect theory, which leads investors to increase risk in an attempt to recover losses, and myopic loss aversion, which causes people to base decisions on short-term price fluctuations at the expense of longer-term benefits. Anchoring is another factor that leads individuals to select a numerical target, regardless of its accuracy, when making complex decisions. Recognizing these cognitive biases is crucial for investors to improve their performance. Going against the crowd is often rewarded by the markets, and those who understand investor sentiment can take advantage of the trends of optimism and pessimism. The Implied Volatility Index, VIX, is a useful tool to monitor sentiment, moving in the opposite direction to investor moods. Understanding the psychology behind investment decisions can lead to more informed investing choices, reducing emotional influences on financial decisions. By recognizing behavioral biases and trends, investors can improve their financial returns and protect themselves from potential losses. Measuring mutual funds. Don't rely on survivorship bias while choosing mutual funds for long-term investment. Instead, Calculate the average yearly performance of all publicly traded funds to know which funds outperform a particular index.
In conclusion, Siegel's book demonstrates the incredible resilience and historical performance of stocks as an asset class, outpacing bonds, commodities, and gold in long-term real returns. As you navigate the complexities of the financial world, remember the importance of understanding your risk tolerance, diversifying your investments, and considering the psychological factors influencing your decisions. This summary highlights the significant insights from the book and emphasizes stocks' potential to grow your wealth, providing the perfect foundation for informed decision-making in your long-term investment journey.